Our speaker tonight is Justin Fox, and he's a graduate from Princeton University, and he has a very long and distinguished career as a journalist, editor, and writer behind him. And a couple of highlights from the past: he has been a writer for Fortune magazine. He's also been an editor with Time magazine and a columnist. And he's currently the executive editor of the Harvard Business Review. And he also serves as a senior fellow at the Kennedy School at Harvard University.
Finance, as it is studied and taught in business schools and elsewhere, has become mostly a discipline of equations. And I don't think that's wrong. I think that's been an advance over what finance was before the 1950s, when it was mostly people just sort of telling stories about what different companies were doing and whether it was a good idea or not. But when you switch everything to equations, you do lose something. You lose some important context. And that was sort of what I was out to do with this book I wrote, and it continues to be sort of a guiding theme in a lot of my work. I just think it's interesting to know where theories come from, so who the people were who came up with them, why they happened to come up with them at a specific period in time, and also more broadly just what it is these theories are attempting to grasp. So what is it that participants in financial markets are up to? There are kind of two main ways to look at it. This is Irving Fisher's way, and I'll talk a little bit more about him in a little bit, but it's basically the argument that what financial markets are doing is trying to figure out what the future is going to be like. In the case of the stock market, it's trying to figure out what the future earnings are of all the corporations being traded on it. In cases of bonds, currencies, it's other economic variables. But the whole idea is that financial markets are trying to reflect what's out there in the economy and what financial market participants think will be out there in the future. Now, the other view, the other main view, is from John Maynard Keynes, and it's that basically what financial markets are doing, what participants in financial markets are doing, is trying to guess what other participants in financial markets are doing, so that the connection to some economic reality is much more tenuous than in the Fisher version. Or here's another way of putting it: I don't buy stocks simply because others are buying them. I buy them because many, many others are buying them. Now, I would say both of these descriptions of financial markets are right. And the Fisher version applies better at some times, the Keynes version at some times. And we're never going to exactly resolve how much sort of predicting the future markets are doing and how much predicting each other's behavior markets are doing. So Fisher started getting this idea that the future was just entirely bright, that things were going to be great in the stock market. And he made this infamous statement, and he made it again and again. It wasn't just a chance thing. But in 1928 and 29, anytime anybody would say that they thought the stock market in the US was getting out of hand, Fisher would say, no, it's high because the economy's working better, because investors are more diversified, and that stock prices have reached, and this was his immortal phrase, have reached a permanently high plateau. They didn't. They crashed in 1929, and Fisher put his money where his mouth is. He went completely broke after the crash. John Maynard Keynes, on the other hand, he was also a mathematician turned economist, but he wasn't as good a mathematician as Fisher. And obviously, he's most famous for his macroeconomic ideas, the argument that in a depression, government needs to step in and spend more than it takes in to goose the economy. He agreed with Fisher's ideas about monetary economics and keeping prices stable. He just didn't think it was enough. So the hypothesis, which had been taking shape at Chicago all through the 60s, was finally put out in complete form by Eugene Fama in a paper delivered at the American Finance Association annual meeting in 1969. And what he was saying more than just it's hard to predict the market. He was saying the ideal is a market in which prices provide accurate signals for resource allocation. So he was saying a market that got prices more or less right. This view led to a lot of very useful stuff. I mean, it can be easy, especially as a journalist who likes to tell stories, to go through how overreaching some of these theories were, but that's sort of how theories work. You try to oversimplify the world and then do useful things with it. And these are some of the things that came out of that whole efficient markets mindset at Chicago in the 1960s. Some of these things could have happened without it, but it would have been a lot slower. Some of them, like modern portfolio theory, had begun before Harry Markowitz was doing his work in the early 1950s. But in general, there was this sort of whole new approach to finance. So useful stuff, not going to deny that. It's probably better for all of us that this happened, that all these people at Chicago had these ideas. But by the late 70s, they were getting a little bit overconfident about it. And this is a famous quote from Mike Jensen. The picture is from graduation at the University of Delaware a couple years ago. He got an honorary degree. But the quote is from a paper, and actually it was introducing an edition of the Journal of Financial Economics where they were starting to look at various anomalies that didn't fit. But this quote always gets pulled out of context. And I think it's fair enough, because I think Jensen believed it pretty strongly at the time, that this is basically the best theory in economics in terms of how well it's held up. And one of Jensen, at that time he was about to switch from University of Rochester to Harvard, but one of his Rochester colleagues, Cliff Smith, would apparently get up in class and basically just yell, "The Price is Right, The Price is Right," which happens to be a game show in the US. But sort of this idea that we figured it out, financial markets, you just look at the prices in financial markets, that's all you need to know. They tell you everything you need to know about the world. What came out of all of this? I mean, first of all, this was sort of where it all started, and it is hard to beat the market. In general, it's a good starting place to think that the market knows better than you do. And I think that's really where a lot of financial theories come from, is this idea that, okay, maybe we're not sure that the market's right, but we're probably sure that it knows more than one individual who thinks he or she is really smart. It's also held up pretty well that there's a trade-off between risk and return. We'll get into the fact that it may be harder to measure that risk than was once thought, but there's definitely a trade-off there. You take more risk if you're going to really hit it big, you've got to take risks. The idea that there's merit in diversification, that's still there too. Not necessarily the sort of total diversification that I think a lot of portfolio theory types would have advised in the 70s, but clearly the continual search for uncorrelated assets, continual and to some extent futile eventually, because once everybody pours into it, it becomes correlated. There's reason why people do that. And then finally, this is a little wonky and arcane, but just the sort of basic idea behind Black-Scholes holds up. It's just knowing the volatility of the underlying asset. What matters is the future volatility, not the past volatility, and it's kind of hard to say sometimes. So the ideas that haven't held up, one is just that the price is right. I mean, the answer is we just don't know if the price is right. After the fact, it's pretty easy to say, oh, it was wrong then. It may have been, it was a good estimate. But I think in general, the answer that's come out of finance on that is then the idea that risk can always be quantified, and that the best way to quantify it is just to look at past volatility. It's just not right. The future, partly something that people in finance realized when they're talking about price behavior, they sort of got that if you saw prices move in a certain way in the past, if everybody started thinking you could bet that they would keep moving in that way, it would change things. That always happens with risk measures, like portfolio insurance in the 1980s, which was this idea of a few finance professors to allow big institutional investors to insure themselves against loss. It was a system that worked perfectly well as long as only a few were doing it. As soon as it was a big enough thing to actually affect the market, it stopped working and played a big role in making the 1987 crash such a big thing. Corporations should always do what financial markets say. It's just, if prices are always right, then it's pretty simple what executives should try to maximize. If they can go wrong for long periods of time, then it just makes this a lot more difficult. The whole idea of maximizing shareholder value becomes a lot more complicated. And finally, this idea that financial markets are inherently stable. And this is an interesting one, because it's not like anybody had any clear theory of this. there was some thought in relation to the work on economic equilibrium that had been done by Kenneth Arrow and Gerard Debreu in the 1950s, that if you just had more financial markets, if people were able to insure themselves against more possible states of the world, you'd get more stability. But it's never been clearly stated as a hypothesis you can disprove, but it was really widely believed. I'm not actually answering your question. I don't know how rational markets are right now. I think thinking about financial markets has evolved to this much more nuanced place. And that, in my view, that's obviously a healthy development, but it's sort of, we're in an interesting point now, because there's been all this work done that calls into question some of the basic underpinnings of financial economics, but nobody has any particularly good replacements. So if you're a finance professor, even one who is a big believer in behavioral finance and market inefficiency and all the rest, if you're teaching first-year MBA students, I'm thinking of Malcolm Baker at HBS who does this. All his academic work is about how markets malfunction. When he goes into class to teach his students, he starts on day one pounding them over the head with the efficient market hypothesis, because he still thinks it's a better starting point than thinking that either there's no theory at all, or every individual, or you as an individual, understand markets better than anybody else. So we're in this interesting place where we have this whole framework that's gotten pretty ragged, but there's nothing that I can tell out there ready to replace it. And with that, I'd love to have some questions and a discussion.